Hello friends, everyone loves to hear about the buyback. This is basically cash reward from the company to the shareholders. But after budget 2026, the tax liability of buyback has been fallen on shareholder instead of the companies. In today's video, we are going to discuss how this tax liability impact the shareholders. So without any further delay, let's get started. Firstly, let us understand what are share buybacks. Share buyback is basically when company repurchases its own share from the shareholders. It generally reduces the outstanding shares, improves the EPS and boosts the share prices. It is a way of rewarding shareholder by the company. It is often seen as an alternative to dividends. So basically, when a company purchases its own shares from the shareholder, it is called buyback. Now, the next question arises, how was buyback taxed earlier? Earlier, the companies has to pay 20% tax on the buybacks plus surcharge plus cess. For shareholders, this process is tax-free. They generally receive the payout without any tax burden. This makes buyback an attractive option as compared to dividend because dividends were taxed in the hands of shareholder and earlier buybacks were tax-free in the hands of shareholder. But now the scenario has been completely changed. After 1st of April 2026, the buybacks were taxed as capital gain in the hands of the shareholder. The tax liability has been shifted from company to the shareholder. This amendment was introduced with the main reason to create parity between the dividend and the buybacks. So basically now the buyback has been taxable in the hands of shareholder as capital gain. Now the next question arises, how much tax is levied on the share buyback? So basically, share buyback are now treated as capital gain, so the capital gain tax rules will apply on share buyback from now on. The rate of tax are as follows. For listed shares, long-term capital gain, that is shares held for more than 12 months, the rate are 12.5%. For short-term capital gain, that is share held for less than 12 months, the rates are slab rate or 20%. For unlisted shares, long-term capital gain is when shares are held for more than 2 years, the rate will be 20% with indexation. And for short-term capital gain, that is the shares which are held for less than 2 years, the rates will be slab rate. Along with this, the promoters are also taxed if they are individual at 30% and if they are corporate promoters at 22%. Now let us understand this concept with a practical example. For example, you purchase some unlisted shares, say 100 quantity at rupees 200. Now the company buybacks the shares at rupees 500. You earn rupees 300 per share, that is total 30,000. The 30,000 will be taxable at the rate of 12.5% if it is long-term capital gain and at slab rate or 20% if it is a short-term capital gain. And now suppose these shares were unlisted shares. So if there is long-term capital gain, rupees 30,000 will be taxed at 20%. And if it is a short-term capital gain, rupees 30,000 will be taxed at slab rate. So basically, type of share and holding period is important to identify how much tax is applicable on the share buyback. Now, this share buyback taxation rules have changed and this impact the shareholders and the impact differs as per the type of shareholder. For example, for the retail investors, net return is lower but long-term capital gain taxation is still better than dividend taxation. And for startup founders or promoters, there is heavy taxation on unlisted shares and ESOP values also get affected. For employees, now the share buyback will be taxed as capital gain and for foreign investors, withholding tax and treaty rules will apply. So basically, this share buyback taxation changes has affected every category of shareholders. Many investors are still getting confusion between the buyback and dividend. So let us understand the difference between the buyback and dividend with a simple chart. With respect to the tax liability, buyback are taxed as capital gain tax now. The dividend will be taxed as dividend income tax. For long-term capital gain rate, buyback will be taxed at 12.5% for listed shares. Dividend will be taxed at slab rate. For short-term capital gain, the buyback will be taxed at slab rate or 20%. For dividend, it will be taxed at slab rate. Cash flow for buyback is flexible, whereas cash flow for dividend is predictable. Now, let us discuss some common mistakes that are generally made while dealing with the share buyback transactions. Number 1. Not adjusting acquisition cost for bonus shares or split shares. Number 2. Ignoring advance tax. Number 3. Treating buyback as tax-free. And number 4. Keeping track of all your share transactions. Frankly speaking, it is very easy to say keep track of all your transactions, but it is very cumbersome and headache for businesses if the transactions involved are high. If we are using manual way of recording transactions, there are many transactions in business which we need to record, which lead to manual errors and inefficient compliances. But it is 2026, the year of AI and automation. If you use a proper AI and automation software, then you are able to handle these transactions very efficiently. For instance, the software which I use is an AI ERP accounting and compliance platform that gives me freedom to manage my compliances and manage my bookkeeping all in one software. It helps me in generating GST invoices, managing records, managing datas, inventories, and preparing the real-time reports. Not only that, it also supports me in managing my compliances like preparing my GSTR1, GSTR3B summary, and also reconciling my GSTR2B with purchase reports. So basically, it is an ecosystem that provides me an accounting and ERP platform along with ease of compliance. It is trusted by 1 lakh plus businesses in 170 plus countries. It provides me features like accounting, invoicing, compliances, payment, inventory, expenses, sales, and vendors. It helps me in managing my businesses very efficiently. If you also want to manage your business stress-free, you can try this software. The link is given in the description. So friends, to conclude, share buyback has been completely changed from 1st of April 2026. But still, if you understand the rules completely and plan smartly, share buyback are still profitable as compared to dividend. So this was our discussion on share buyback from 1st of April 2026 and how they impact your taxation. If you have any question regarding this topic, please let us know in the comment. Thank you.